Before we dive in, please remember that the information in this video is for educational purposes only. I am not a licensed financial advisor, mortgage lender, or real estate agent. The mortgage landscape changes constantly, and your individual situation is unique. Always consult with qualified professionals before making any financial decisions. This presentation is not financial advice. You've done it. You've spent 6 months glued to your phone, endlessly scrolling through Zillow and Redfin. You've favorited dozens of homes, you've done the virtual tours, you've even mapped out the commute. You finally find it, the one. The house with the perfect backyard for the dog. The kitchen with the island you've always dreamed of. In the school district you need. You can already picture where the Christmas tree will go. Your heart is racing. This is it. You find a lender, you fill out the online application, you upload your documents, and you wait. You're nervous but optimistic. You have a good job, you've saved some money, you should be fine, right? And then the email lands in your inbox. The subject line is generic, but your stomach drops anyway. You open it, and there are the words every homebuyer dreads. We regret to inform you. It feels like a punch to the gut. All that dreaming, all that planning evaporates in an instant. You're left with one crushing question. What went wrong? The truth is, for millions of Americans, the mortgage approval process feels like a total black box. It's an intimidating, confusing, and secretive system where you hand over your entire financial life and just hope for the best. You're judged by a mysterious set of rules you don't understand, by an underwriter you'll never meet. But what if I told you it doesn't have to be that way? What if I told you that you could get your hands on the lender's secret playbook? What if you could walk into that application process knowing exactly what they're looking for, what they're scared of, and how to present yourself as the perfect, undeniable, approved candidate they are desperate to lend money to? That is precisely what we are going to do in this series. We are going to kick down the door to the underwriter's office, open up the vault, and demystify every single guideline that stands between you and the keys to your new home. Forget everything you think you know. Forget the vague advice from your parents or the outdated articles you read online. The world of lending has changed, and the rules are more specific than ever. Getting approved for a mortgage isn't about just one thing. It's about mastering 4. Think of it like a table with 4 strong legs. If one leg is wobbly, the entire thing can come crashing down. These are the 4 pillars of mortgage approval, and over the next several parts we're going to become experts in every single one. The first pillar is your credit. The second is your income. The third is your assets. And the fourth, which most people forget, is the property itself. Your application is a story told across these 4 pillars, and the underwriter is the critic who reads it. Our job is to make sure your story is a bestseller. Let's start with the biggest one, the one that causes the most confusion and anxiety: credit. Most people think this is simple. You check your score on an app like Credit Karma, you see a number like 720 and you think, great, I'm golden. I'm here to tell you that this is one of the most dangerous assumptions you can make. That score you see? It's what's called a Vantage score. It's a great educational tool, but it is almost never the score your mortgage lender will actually use. Lenders use a different scoring model, typically a FICO score, and they don't just pull one. They pull a special report called a tri-merge, which grabs your FICO score from all 3 major credit bureaus: Experian, Equifax, and TransUnion. You'll have 3 different scores, and guess which one they use? Not the highest, not the average. They use the middle score. So if your scores are 710, 725, and 740, your qualifying score is 725. Right off the bat, the number you thought you had might be completely different. But here's the real secret, the part that separates the approved from the denied. The score itself is only the headline. The underwriter is reading the full story underneath. I want you to imagine 2 different buyers. Buyer A is named Alex. Alex has a 750 credit score. Looks amazing, right? But in the last 12 months, Alex has opened 3 new credit cards to get the sign-up bonuses, and just bought a brand new car, adding a $600 monthly payment. Now let's look at buyer B. We'll call her Brenda. Brenda's middle FICO score is only 710. On the surface, she looks like a weaker applicant. But when the underwriter looks closer, they see Brenda has had the same 2 credit cards for 10 years, has never once missed a payment, and keeps her balances below 10% of her limit. She has no other recent debt. Who do you think the bank sees as the safer bet? It's Brenda by a landslide. Why? Because Alex's recent activity is a massive red flag. It's called credit-seeking behavior. To a lender, it looks like Alex is suddenly desperate for cash or is about to take on a mountain of new debt. It signals instability. Brenda, on the other hand, demonstrates long-term stability and predictability. She's proven for a decade that she is a responsible borrower. Lenders are not in the business of taking risks. They are in the business of predictability. A lower score with a boring, stable, predictable history is infinitely more attractive than a high score with recent, chaotic, unpredictable behavior. This is what we mean by understanding the guidelines. It's not just about the number. It's about knowing what that number is made of. It's about your credit utilization. That's the percentage of your available credit that you're using. Anything over 30% starts to raise eyebrows and drop your score. It's about your payment history. A single 30-day late payment on a car loan from 2 years ago can be more damaging than you think, because it tells the underwriter that when times got tough, you didn't prioritize your secured debt. It's about the age of your credit accounts and the mix of credit you have. They want to see that you can responsibly handle both revolving debt, like credit cards, and installment loans like a student loan or car loan. So the first step in this entire journey, before you even think about talking to a lender, is to get a true picture of your credit from their perspective. You need to see your actual FICO scores and review your full credit reports from all 3 bureaus. Look for errors, look for old collection accounts you forgot about, and look at the story it's telling. Are you Alex, the high score with a chaotic recent history? Or are you Brenda, the steady, reliable borrower? Knowing this upfront gives you the power to fix problems, pay down balances, and craft your credit story long before an underwriter ever sees it. That's just the first pillar. In the coming parts, we are going to apply this same deep dive logic to the other 3. We'll talk about income and how it's not about how much you make but about how you document it and for how long. We'll show you why a W-2 employee making $70,000 a year is often seen as a stronger borrower than a self-employed person who made $200,000 last year. We'll break down the 2-year rule for job history and how to navigate it if you're in the gig economy or just switched careers. Then we'll move to the third pillar, assets. This is your cash. We are going to completely dismantle the myth that you need 20% down. We'll explore low down payment FHA and conventional loans that let you get in for as little as 3% down. We'll talk about where that money can come from, the critical rules around seasoning your funds, and how to properly accept a gift from a family member without raising red flags that could kill your entire loan. Finally, we'll cover the fourth pillar, the one everyone forgets, the property itself. The house has to qualify too. We'll dive into the appraisal process, what happens if it comes in low, and the common property issues from a leaky roof to an unpermitted addition that can cause the lender to back out at the 11th hour even after you've been fully approved. This isn't just information. This is a strategy. By the end of this series, you will no longer feel like you're guessing. You will have a clear, actionable roadmap. You will understand your own financial picture through the exact same lens as a mortgage underwriter. You will have the confidence and the knowledge to command the home buying process, avoid the common pitfalls that lead to denial, and turn that gut-wrenching, "we regret to inform you," into the 3 words you've been dreaming of. You're cleared to close. Let's get started. To understand the mortgage game, you have to understand the mind of the lender. To them, you aren't a person with dreams of a white picket fence. You are a risk profile, a collection of data points on a spreadsheet, and their entire job, the sole purpose of all this paperwork, is to answer one single question. If we lend this person hundreds of thousands of dollars, what are the odds we get it back? That's it. That's the whole game. Everything they do, every document they ask for, every guideline they enforce, is designed to answer that one question. And they do it by looking at 3 specific things. This is the lender's holy trinity, the 3 pillars that your entire application will stand or fall on. They are what we call the 3 C's: credit, capacity, and collateral. Get these 3 things right, and the doors to homeownership swing wide open. Get just one of them wrong, and that door slams shut, often with your fingers still in the jam. For the rest of this series, we are going to dissect each of these pillars, but today we're starting with the one that trips up more people than any other: credit. Now, when I say credit, your mind probably jumps straight to one thing: your FICO score. That 3-digit number that we're all taught to obsess over. And yes, it's important. It's the headline of your financial story. Generally speaking, for most conventional loans, you'll need a minimum score of 620. But let's be brutally honest. A 620 score is like trying to climb Mount Everest in flip-flops. It's technically possible, but it's going to be an incredibly painful, expensive, and difficult journey. You'll face higher interest rates, stricter requirements, and a much smaller pool of willing lenders. As you climb into the high 600s, things get better. Once you cross the 740 threshold, you're in the VIP lounge. You get the best rates, the most favorable terms, and lenders practically roll out the red carpet for you. But here's the secret that most people miss. The score is just the headline. The lender is going to read the entire article. Your credit report is infinitely more important than your credit score. Your report tells a story. It's your financial biography, and the underwriter is going to read every single word. They are looking for the narrative. Are you a responsible borrower who consistently meets your obligations? Or are you someone who struggles, who lives on the edge, who might be one missed paycheck away from disaster? Let's break down what they're actually reading. First, and most critically, is your payment history. This accounts for a massive 35% of your FICO score. One late payment from 2 years ago can be the single red flag that kills your deal. We're talking about a 30, 60, or 90-day late payment on a car loan, a student loan, or a credit card. To a lender, a past late payment is a predictor of future behavior. If you couldn't handle a $400 car payment, they're terrified you won't be able to handle a $3,000 mortgage payment. So, rule number 1 before you even think about applying, make sure every single bill has been paid on time for at least the last 12 to 24 months. No exceptions. The second thing they scrutinize is your credit utilization. This is the silent killer of mortgage applications. Utilization is simply the amount of credit card debt you have compared to your total credit limits. You've probably heard the 30% rule. Keep your balances below 30% of your limit. Well, I'm here to tell you that for a mortgage application, the 30% rule is garbage. It's the bare minimum. World-class applicants, the ones who get instant approvals, keep their utilization under 10%. The true pros? They're under 5%. Think about it from the lender's perspective. If you have $10,000 in available credit and your balance is $3,000, that's okay. But if your balance is $9,000, the lender sees someone who is stretched thin, someone who is relying on debt to live. It signals financial distress. Here's a multi-thousand-dollar tip. A month or two before you apply for a mortgage, pay your credit cards down to almost zero. Let the statement close with a tiny balance like $5 or $10 and then pay it off. This reports a near zero utilization to the credit bureaus, which can dramatically boost your score in a very short period of time. Next on the list is the length of your credit history. Lenders love to see a long, established history of responsible borrowing. This is why you should never ever close your oldest credit card account. Even if you don't use it, that card is the anchor of your credit age. Closing it can shorten your history and cause your score to drop. Just put a small recurring bill on it, like Netflix, set it to autopay, and let it age gracefully like a fine wine. They also look at your credit mix. They want to see that you can handle different types of debt responsibly. A mix of revolving credit like credit cards and installment loans like a car loan or a student loan looks much better than just having one or the other. It shows you're a versatile and trustworthy borrower. Finally, and this is where so many people shoot themselves in the foot, is new credit. In the 6 to 12 months leading up to your mortgage application, your credit report should be a ghost town. No new activity. Do not go out and buy a new car. Do not apply for a new credit card to get 10% off at a department store. And for the love of all that is holy, do not finance new furniture for the house you haven't even bought yet. I once saw a deal fall apart 3 days before closing because the couple went to a big box store and financed a $7,000 washer, dryer, and refrigerator set. That single credit inquiry and the new debt completely changed their debt-to-income ratio, and the lender pulled the plug. They lost the house. They lost their inspection money. They lost their appraisal money. All for a washing machine. Every time you apply for new credit, it dings your score, and more importantly, it sends a bright red flare to the underwriter that says, this person's financial situation is changing. Lenders hate change. They want stability. So put yourself in a credit lockdown. No new accounts, no new inquiries, period. So to recap on credit, the score gets you in the door, but the report gets you the loan. Pay every single bill on time. Crush your credit card balances to below 10% utilization. Keep your old accounts open. And don't apply for any new credit whatsoever. Mastering your credit is the first, and arguably the most important pillar of the 3 C's. But it's only 1/3 of the equation, because you can have a perfect 850 credit score, but if you don't have the income to support the mortgage payment, you're still getting denied. This brings us to the second pillar, the second C, capacity. Capacity is the lender's word for your ability to repay the loan. It's all about your income and your existing debts. They need to be 100% certain that you have enough cash flow every month to cover your proposed new mortgage payment, plus your property taxes, your homeowner's insurance, and all of your other financial obligations, with room to spare. How do they figure this out? With a simple but ruthless calculation known as the debt-to-income ratio, or DTI. This single number is the gatekeeper of your mortgage approval. It is a non-negotiable black-and-white metric that will determine the absolute maximum amount of house you can afford in the eyes of the bank. And the way they calculate your income, especially if you're self-employed, a gig worker, or get paid in commissions or bonuses, is incredibly specific and often shocks people. It is almost never the number you think it is. Your DTI is the true ceiling on your purchasing power, and if you don't understand how it's calculated down to the penny, you're flying blind straight into a wall of denial. So let's pull back the curtain on this mysterious number. DTI stands for debt-to-income ratio, and it's the lender's single most important metric for measuring your ability to repay a loan. It's a simple percentage that tells them how much of your monthly income is already spoken for by debt. And here's the first secret. There are actually two DTIs. The first is called the front-end ratio. This is just your future housing payment, the principal, interest, taxes, insurance, and any HOA fees, divided by your gross monthly income. It's a useful number, but it's not the one that makes or breaks your approval. The second DTI, the one that holds all the power, is the back-end ratio. This is the final boss. The back-end ratio takes all of your monthly debt obligations, your car loan, your student loans, the minimum payments on your credit cards, and your future housing payment, and divides that total by your gross monthly income. This number, this single percentage, is what underwriters obsess over. It's the number that determines the absolute maximum loan you can qualify for. To truly understand it, we have to break it down piece by piece, starting with the most misunderstood part of the entire equation, the I for income. When a lender looks at your income, they are not looking at your take-home pay. They don't care about your net. They start with your gross monthly income. That's your salary before a single dollar is taken out for taxes, health insurance, or your 401k. If you're a salaried W-2 employee with a steady paycheck and no other variables, this part is simple. They take your annual salary, divide it by 12, and that's your number. But for tens of millions of Americans, it is nowhere near that simple. What if you get overtime, or bonuses, or commissions? The lender sees that income as volatile, unreliable. To count it, they have to prove it's stable. And the only way they know how to do that is to look backward. They will demand your last 2 years of W-2s and your most recent pay stubs. They will then take the total amount of overtime or bonus or commission you earned over the last 24 months, and they will average it. Let me say that again. They average it over 24 months. So if you had an incredible year last year and made a $50,000 bonus, but the year before you only made $10,000, they don't care about your recent success. They will add 50 plus 10, get 60,000, divide it by 24, and they will only credit you with $2,500 a month in bonus income. Even if your pay stub shows you're on track to make far more this year. This single calculation crushes the purchasing power of countless salespeople, nurses, tradespeople, and anyone else who relies on variable pay. You might be earning more than ever, but the bank is looking in the rearview mirror. Now, for the self-employed, the freelancers, the small business owners, this is where the dream of homeownership can turn into a nightmare. The bank doesn't look at your invoices or your gross revenue. They look at one thing and one thing only, the net income on your tax returns. After all your write-offs, after you've paid your accountant to find every possible deduction to lower your tax bill, the bank uses that final, low number against you. Just like with variable income, they will demand your last 2 years of business and personal tax returns, every single page. They will then take the net income from those 2 years, add them together, and divide by 24 to get your average monthly income. If your income declined from the first year to the second, they might only use the lower, more recent year's income. Or worse, they might deny the file altogether, seeing it as a business in decline. You could be having your best year ever right now, cash flowing like crazy, but if it's not on the last 2 years of filed tax returns to the underwriter, it doesn't exist. This is the self-employment trap. You spend years minimizing your tax liability, only to have that strategy disqualify you from the home you've been working for. So that's the I in DTI. It's not what you make. It's what you can prove you've made consistently over the last 2 years, calculated in the most conservative way possible. Now let's talk about the D for debt. This side of the equation is a little more straightforward, but it has its own set of traps. The lender will pull your credit report, and every single monthly payment listed on it goes into the calculation. Your car payment? That's in there. Personal loans? In there. But here's a small piece of good news. For credit cards, they don't use your total balance. They only use the minimum monthly payment required. So if you have $10,000 on a card, but the minimum payment is only $150, only that $150 counts against your DTI. But now for the big one, the debt that trips up more millennial and Gen Z buyers than any other: student loans. The rules here are incredibly specific and unforgiving. Even if your loans are in deferment or forbearance and you currently aren't paying a dime, the lender has to count a hypothetical payment against you. They can't just put a zero in the debt column. For conventional loans, they will typically take 1% of your total student loan balance and use that as your monthly payment. So if you have $80,000 in student loans, even if you're on an income-based repayment plan paying $200 a month, the lender might ignore that and hit you with an $800 monthly payment in their calculation. That's an extra $600 of phantom debt that just obliterated your purchasing power. For FHA loans, the rule is often 0.5%, but the principle is the same. The bank invents a payment and you have to qualify with it. It is absolutely brutal. Finally, they add any other legal obligations you have, like alimony or child support. That full monthly amount goes directly into the debt side of the ledger. Okay, let's put this all together. Let's calculate a real DTI. Imagine a buyer. Let's call her Sarah. Sarah is a salaried manager who also gets a quarterly bonus. Her base salary is $72,000 a year. Her gross monthly income from her salary is $6,000. Over the last 24 months, she earned a total of $24,000 in bonuses. The lender averages this out, giving her an extra $1,000 a month in qualifying income. So her total gross monthly income for DTI purposes is $7,000. Not what she thinks she makes. Not what she's on track to make this year. It's $7,000. Period. Now for her debts. She has a $450 car payment. She has $30,000 in student loans, and her actual income-based payment is $150. But the lender uses the 1% rule, so they calculate her student loan payment as $300. She also has a few credit cards with a total minimum payment of $120. So her total non-housing debt is $450 plus $300 plus $120, which equals $870. Now let's say Sarah wants to buy a house where the total monthly payment, principal, interest, taxes, and insurance, is $2,500. To calculate her back-end DTI, the underwriter will add her existing debts, $870, to her proposed new housing payment, $2,500. That gives her a total monthly debt of $3,370. The final step, they divide that total debt by her qualifying monthly income. So $3,370 divided by $7,000 equals 0.481. As a percentage, that's a DTI of 48.1%. This is the moment of truth. Every loan program, conventional FHA, VA, has a maximum allowable DTI. It's a hard line in the sand. If your DTI is even 0.1% over that line, the computer says no. You get denied. That black and white. So what are those magic numbers? What are the absolute DTI ceilings for the most common loan types in America? For a conventional loan, the standard limit is often 43%, though it can sometimes be pushed to 45% or even 50% if you have a huge down payment and a high credit score. For an FHA loan, it's generally higher, often allowing you to go up to 50% or in some cases even 56.9%. Knowing these limits is like knowing the rules of the game you're about to play. Sarah, with her 48.1% DTI, would likely be denied for a standard conventional loan. She'd be approved for an FHA loan, but that comes with its own set of costs and requirements. This one number dictates everything. It tells you which loan programs you can use, which houses you can afford, and which neighborhoods you can even consider. Getting this calculation wrong, or using your take-home pay, or guessing at your bonus income isn't just a small mistake. It's the difference between getting a pre-approval letter and getting a denial. It's the difference between being a confident, strategic buyer and a hopeful applicant just waiting for bad news. Understanding your true lender-calculated DTI is the first, most critical step in taking control of this process. And now that you know how to calculate it, the next step is to understand the different arenas you can play in, because the rules for conventional FHA and VA loans are vastly different, and choosing the right one can completely change your future. Let's break down these three arenas: conventional, FHA, and VA. Think of them not just as loan types, but as different paths to the same destination. Each path has its own terrain, its own rules, and is designed for a different kind of traveler. Choosing the wrong path can make the journey 10 times harder than it needs to be. First up is the most common path, the one you hear about most often, the conventional loan. This is the gold standard of the mortgage world. It's not backed by a specific government entity like the others. Instead, it's what the private market, lenders like banks and credit unions, offers to borrowers they see as a good, solid bet. To walk this path, you generally need to be in good financial shape. The first checkpoint on the conventional path is your credit score. Lenders are looking for a history of responsible borrowing. While you can technically get a conventional loan with a score as low as 620, that's like trying to run a marathon with a sprained ankle. You might finish, but it's going to be painful, and your interest rate will reflect that pain. The magic number, the one that unlocks the best interest rates and terms, is typically 740 or higher. Think of your credit score like a trust score. The higher it is, the more the lender trusts you'll pay them back, and the less they'll charge you in interest for the privilege of borrowing their money. Now let's tackle the biggest myth in all of real estate: the 20% down payment. For decades, people have believed you absolutely must have 20% of the home's price in cash to get a conventional loan. That is simply not true. You can get a conventional loan with as little as 3% down, especially if you're a first-time homebuyer. But, and this is a huge but, if you put down less than 20%, you have to pay for something called PMI, or private mortgage insurance. This is one of the most misunderstood concepts, so listen closely. PMI is not for you. It does not protect you if you lose your job or can't make a payment. PMI is insurance that you pay for to protect the lender in case you default on the loan. It's the lender's safety net because they see you as a slightly higher risk with less skin in the game. This extra fee, which can be hundreds of dollars a month, gets added right on top of your mortgage payment. But here's the crucial piece of information about PMI that can save you thousands. It's not permanent. Once you've paid down your mortgage to the point where you have 20% equity in your home, meaning your loan balance is 80% of the home's original value, you can call your lender and request to have the PMI removed. And even better, by law, they are required to automatically terminate your PMI once your loan balance hits 78% of the original value. Knowing how to get rid of PMI is a financial superpower. Finally, conventional loans have limits. They are called conforming loans because they have to conform to the maximum loan amount set by the Federal Housing Finance Agency. This amount changes every year and varies by county. If you need to borrow more than that limit, you move into the world of jumbo loans, which have their own, often stricter set of rules. So, the conventional path is for the borrower with a strong credit history, stable income, and some savings for a down payment. It offers flexibility and, most importantly, a way to avoid long-term mortgage insurance. But what if your credit isn't perfect? What if you haven't had years to save up a big down payment? That's where our second path comes in. This is the FHA loan. The FHA, or Federal Housing Administration, doesn't actually lend you money. They insure the loan for the bank. They're essentially telling the lender, hey, go ahead and give this person a mortgage. They might not fit your perfect conventional mold, but if they default, we've got your back. This government backing opens the door to homeownership for millions of people. The FHA path is designed for accessibility. The credit score requirement is much, much lower. You can get an FHA loan with a credit score as low as 580 with just a 3.5% down payment. If your score is between 500 and 579, you might still get approved, but you'll likely need to put 10% down. This flexibility on credit is a game changer for so many Americans. And that 3.5% down payment is the FHA's headline feature. It makes the dream of owning a home feel incredibly close, even if your savings account isn't overflowing. But just like with the conventional loan, there's a catch. And the FHA's catch is a big one. It's their version of mortgage insurance called MIP, or mortgage insurance premium. And it works very differently from PMI. With an FHA loan, you get hit with mortgage insurance twice. First, there's an upfront mortgage insurance premium, which is a one-time fee, typically 1.75% of your loan amount, that gets rolled into your total mortgage balance. You pay interest on it for the life of the loan. Then you also have an annual mortgage insurance premium, which is paid monthly just like PMI. But here is the single most important thing you need to understand about FHA loans. If you put down less than 10%, that monthly mortgage insurance premium is for the entire life of the loan. It never goes away. It doesn't matter if you have 20% equity, 50% equity, or you're one payment away from owning the house free and clear. You will pay that MIP every single month until you sell the house or refinance into a different type of loan. This is the trade-off. The FHA gives you incredible access on the front end, but it costs you significantly more on the back end. It's a financial ball and chain that you can't just ask to have removed. Now there is a third path, a truly special one, reserved for a specific group of people. This is the VA loan. This isn't just a loan program. It's an earned benefit for those who have served or are currently serving in the U.S. military, and in some cases, their surviving spouses. The VA loan has two superpowers that make it arguably the best mortgage product on the planet. The first superpower is its most famous feature: zero down payment required. 100% financing. You can buy a home with literally no money down. For a veteran trying to transition back into civilian life, this can be the difference between renting for another decade and starting to build generational wealth right now. Its second superpower? No monthly mortgage insurance. None. Zero. Zilch. Think about that. On a conventional loan, you pay PMI if you put down less than 20%. On an FHA loan, you pay MIP, possibly for the life of the loan. On a VA loan, even with $0 down, there is no monthly mortgage insurance fee. This saves veterans hundreds of dollars every single month, freeing up that cash for savings, investment, or just living a better life. So you're probably thinking, what's the catch? There has to be a catch. And there is, but it's a manageable one. It's called the VA funding fee. This is a one-time fee paid to the VA to help keep the program running for future generations of service members. The fee is a percentage of the loan amount and it varies. It depends on your branch of service, how much you're putting down, and whether it's your first time using your VA loan benefit. For a first-time user with zero down, it's typically 2.3% of the loan amount. Now, this fee can be rolled into the loan itself so you don't have to pay it out of pocket. And here's another critical detail. Veterans who receive compensation for a service-connected disability are often exempt from paying the funding fee entirely. The VA also looks at your qualifications differently. While private lenders will still look at your credit score, the VA itself encourages them to take a more holistic view. They focus heavily on something called residual income, the amount of money you have left over at the end of the month after paying all your major expenses, including your new mortgage. They want to be sure you can truly afford the home without financial stress. So we have three distinct paths. The conventional loan, for the financially established borrower looking for flexibility and the lowest long-term cost. The FHA loan, the great accessible option for those with less than perfect credit or minimal savings, but with a costly long-term insurance burden. And the VA loan, a phenomenal hard-earned benefit for our service members, offering an unparalleled path to homeownership with no down payment and no monthly mortgage insurance. Each one is a powerful tool, but the loan you can get isn't always the loan you should get, because the numbers on the application are only half the story. The other half is about your life, your goals, and your financial future. And in the next part, we're going to break down the hidden costs and long-term consequences of each choice, so you can pick the one that builds you wealth, instead of just getting you a key. So let's talk about that key. Because when you see a house listed online for $400,000, your brain immediately starts doing the math on that $400,000. But that number, that's a mirage. It's the sticker price on a car before the dealer adds the destination fees, the dock fees, the title, the taxes, and that mysterious paint protection package you never asked for. The number on the sign is never the number on the check. And with a mortgage, the difference isn't a few $1,000s. It can be tens, even hundreds of thousands of dollars over the life of the loan. The first and most misunderstood hidden cost is a four-letter acronym that haunts millions of homeowners: PMI, Private Mortgage Insurance. And for FHA loans, it's called MIP, or Mortgage Insurance Premium. Same monster, different name. Now what is it? It's insurance, but here's the kick in the teeth. It doesn't protect you. It protects the lender. You are forced to pay a monthly insurance premium so that if you default on your loan, the bank gets its money back. You are literally paying to insure your own risk for someone else's benefit. Think about that. It's like your car insurance company making you pay extra every month just in case you stop paying your car loan. It's a cost that builds you zero equity. It doesn't pay down your principal. It doesn't go toward your interest. It vanishes into thin air every single month. For many first-time homebuyers, especially those using FHA loans or putting down less than 20% on a conventional loan, PMI can add hundreds of dollars to their monthly payment. A $300,000 loan could easily have a $200 PMI payment tacked on. That's $2,400 a year. Over 5 years, that's $12,000 you've lit on fire. Money that could have gone into retirement, investments, or paying down your actual loan faster. Here's the long-term consequence we talked about. With a conventional loan, there's a light at the end of the tunnel. Once your loan-to-value ratio hits 80%, meaning you've paid down your mortgage to 80% of the home's original value, or the home has appreciated enough, you can request to have PMI removed. By law, it must automatically be terminated when you reach 78%. But with an FHA loan, if you put down less than 10%, that mortgage insurance premium is with you for the entire life of the loan. The whole 30 years. The only way out is to refinance into a conventional loan, which comes with its own set of costs. So that FHA loan that looks so attractive with its low down payment suddenly has a financial ball and chain attached to it for decades. But that's a monthly cost. Let's talk about the giant financial hurdle you have to clear just to get the keys. Closing costs. This is the big one that blindsides so many buyers. You save up for the down payment, you get pre-approved, you find the house, and then a week before closing, you get a document showing you need to bring an extra $10,000, $12,000, even $15,000 to the table. Where does this money go? It's a collection of fees, a financial buffet of charges from everyone who touched your loan. First, you have the lender fees. The big one is the origination fee. This is literally the lender's fee for creating the loan. It's their paycheck. Then there are processing and underwriting fees. Think of this as paying for the salary of the people in the back office who are meticulously tearing your financial life apart. Next are the third-party fees. This is for services you need but don't hire directly. The appraisal fee? You have to pay an independent appraiser a few $100 to confirm for the bank that the house is actually worth what you're paying for it. The credit report fee? Yep, you pay for them to pull your own credit. Title insurance is a huge one. This protects you and the lender from any weird ownership claims from the past. What if the seller's long-lost uncle shows up with a competing will? Title insurance handles that. You pay for a lender's policy and an owner's policy. Then you have the prepaids. This is where it gets even more confusing. You are often required to prepay a full year's worth of homeowner's insurance premiums right at closing. You also have to prepay interest on the mortgage for the remaining days of the month you close in. And finally, you have to fund your escrow account. What on earth is an escrow account? Lenders don't trust you. It's that simple. They don't trust that you'll save up and pay your property taxes or your homeowner's insurance on time. Because if you don't, the government can put a lien on their asset, your house, or if it burns down uninsured, their investment is gone. So, they create a forced savings account called escrow. Every month, along with your principal and interest, you pay a little extra. Typically 1/12 of your annual property tax bill, and 1/12 of your annual homeowner's insurance premium. That money sits in the escrow account, and when those big bills come due, the lender pays them for you out of that account. At closing, you have to pre-fund this account with several months' worth of these payments to get it started. So your real monthly payment isn't just principal and interest or P&I. It's PITI. Principal, interest, taxes, and insurance. And if you have PMI, it's really PITI plus PMI. That is the true number that dictates your budget. A $3,000 P&I payment can easily become a $4,000 total payment once you add in high property taxes, insurance, and PMI. This is the number that matters. This is the number you have to be able to afford when you're sick, when you lose your job, when life happens. Now, sometimes a lender will offer you a way to lower that number. They'll talk to you about points. You'll hear them say, for just 1 point, we can lower your interest rate from 7% to 6.75%. Sounds great, right? But what is a point? 1 point is 1% of the total loan amount. On a $400,000 loan, 1 point is $4,000. Cash. Due at closing. So you're being asked to pay $4,000 today to save a small amount every month for the next 30 years. You have to do the math. Let's say that 0.25% rate reduction saves you $75 a month. You paid $4,000 to get that savings. So you divide 4,000 by 75. The answer is about 53. It will take you 53 months, almost 4.5 years, just to break even on the money you paid up front. If you sell the house or refinance in 3 years, you lost money on that deal. Buying points is a gamble on your own future. You're betting that you'll stay in that house with that loan long enough to make the upfront costs worthwhile. Sometimes it's a great move, especially if you know you're in your forever home. But often, It's just a way to make your loan look more attractive while draining your cash reserves right when you need them most. These are the hidden gears of the mortgage machine. PMI, closing costs, escrow points, they are designed to protect the lender, and they are funded by you. Understanding them isn't just about avoiding surprises. It's about taking control of the process. It's about knowing which levers to pull and which fees to question. Because every dollar you save at the closing table or on your monthly payment is a dollar you can put toward your own wealth, not the bank's. Now you understand the true cost. You know the difference between the sticker price and the out-the-door price. You're armed with the knowledge of what PITI plus PMI really means for your monthly budget. But knowing the cost is only half the battle. Now you have to actually apply. And this is where the real scrutiny begins. This is where a team of underwriters puts your entire financial life under a microscope. They will comb through your bank statements, question every large deposit, analyze your spending habits, and build a complete picture of you as a financial risk. And the smallest, most innocent mistake can get you a soul-crushing denial. But it doesn't have to be that way. In the next part, we are going to pull back the curtain on the underwriting process. I'm going to show you exactly what they look for, the red flags that send them running, and how to prepare your financial documents like a seasoned pro, so when you finally hit submit on that application, you're not just hoping for an approval, you're expecting it. So let's pull back the curtain. When an underwriter gets your file, they aren't just a number cruncher. They're a financial detective. Their one and only job is to answer a single critical question for the bank. If we lend this person hundreds of thousands of dollars, what is the probability we will get it back? That's it. Everything they do, every document they ask for, is designed to solve that puzzle. And to do it, they use a framework that has been the bedrock of lending for decades. It's often called the 3 C's of credit: capacity, capital, and collateral. Master these 3, and you'll understand the mind of the lender. First, and arguably most important, is capacity. This is your ability to repay the loan. It's not about how much money you have in the bank. That's the next C. This is purely about your income versus your debts. The magic number here is your debt-to-income ratio, or DTI. You're going to hear this term 1,000 times, so let's burn it into your brain. DTI is a percentage that shows how much of your gross monthly income, that's your income before taxes, goes towards paying your monthly debts. Let's make this real. Imagine you and your partner make a combined $10,000 a month before taxes. That's your gross monthly income. Now, the lender looks at all your existing monthly debt payments that show up on your credit report. Let's say you have a $500 car payment, a $150 student loan payment, and a $50 minimum payment on a credit card. Your total monthly debt is $700. Now let's add in the proposed new housing payment. The lender will calculate your estimated principal, interest, taxes, and insurance, often called PITI, plus any HOA fees. Let's say that comes out to $2,800 a month. So your total proposed monthly debt is the old $700 plus the new $2,800, which equals $3,500. To get your DTI, the lender divides that total debt, $3,500, by your gross monthly income, $10,000. That gives you 0.35, or a DTI of 35%. So what's a good number? Most lenders want to see your DTI at or below 43%. Some programs like FHA loans might stretch to 50% or even a little higher if you have other compensating factors like a high credit score or significant savings. But 43% is the magic number for most conventional loans. If your DTI is creeping up to 50% or more, that's a massive red flag. It tells the lender you'll have very little breathing room in your budget, and any unexpected expense could put you at risk of default. Now, proving this income isn't as simple as showing one pay stub. Lenders need to see stability and consistency. If you're a W-2 employee who gets a regular salary, this is the easiest path. They'll typically ask for your last 2 years of W-2s, your most recent 30 days of pay stubs, and they'll call your employer to verify you're still employed. They're looking for a consistent work history, preferably in the same line of work. A big unexplained gap in employment can be a red flag. But what if you're self-employed, a freelancer, or work on commission? This is where it gets trickier. The lender can't just look at your best month. They need to see a stable, predictable pattern. For self-employed borrowers, get ready to hand over your last 2 years of complete, filed federal tax returns, all pages. They will average your net income over those 2 years to determine your qualifying monthly income. That's a key point. They look at your net income after you've taken all your business deductions. So that new truck you wrote off as a business expense? It saved you on taxes, but it just lowered the income you can use to qualify for a mortgage. This is a classic trap for entrepreneurs. A declining income from one year to the next is a major red flag that will almost certainly require a detailed letter of explanation. The second C is capital. This is the money you have saved up. It's your liquid assets. Checking accounts, savings accounts, stocks, bonds, 401ks. Capital serves two purposes in the lender's eyes. First, it proves you have the funds for the down payment and closing costs. Second, it shows you have reserves. A financial cushion to fall back on if you lose your job or face an emergency. Lenders want to see that you're not draining every last penny to buy the house. Here's the part that trips up almost everyone. Seasoned funds. Lenders will require your last 2 months of bank statements for every account you're using, and they will scrutinize every single page. They need to see that the money for your down payment has been seasoning in your account for at least 60 days. Why? Because they need to ensure that money is truly yours, and not a secret undocumented loan from a friend or family member. A new loan would increase your DTI and change your entire risk profile. Any large, non-payroll deposit that appears on those statements is a giant red flag. What's large? It varies, but any single deposit that's more than, say, 50% of your monthly income will raise questions. If your uncle gives you $20,000 in cash and you deposit it, the underwriter will hit the brakes. You'll have to source it, prove exactly where it came from. If it was a gift, you'll need a signed gift letter from the donor stating the money is a true gift with no expectation of repayment, and you'll need to provide a paper trail showing the funds leaving their account and entering yours. Selling a car? You'll need the bill of sale and a copy of the check. It feels invasive, but remember their goal: to ensure every dollar is accounted for, and not a hidden debt. The third and final C is collateral. This is the house itself. You could have a perfect 850 credit score, a 20% DTI, and $1 million in the bank, but if the house you want to buy isn't worth what you're paying for it, the deal is dead. The lender is not just lending money to you. They are lending money against the value of the property. If you stop making payments, their only recourse is to foreclose and sell the house to get their money back. So they need to be absolutely certain the house provides enough security for the loan. This is where the appraisal comes in. The lender will hire a licensed, third-party appraiser to provide an independent, professional opinion of the property's value. The appraiser will inspect the home, measure it, note its condition and features, and then compare it to at least 3 similar homes, known as comparables or comps, that have recently sold in the same neighborhood. The number they come back with is critical. The house must appraise for at least the purchase price. If you agree to buy a house for $400,000, but the appraiser says it's only worth $380,000, you have what's called an appraisal gap. The lender will only lend you money based on the lower value, the $380,000. This creates a $20,000 shortfall that has to be covered. You can try to renegotiate the price with the seller. You can pay the $20,000 difference in cash out of your own pocket, or if you can't do either, you may have to walk away from the deal. A low appraisal is a deal-killing red flag, and it's completely out of your control. So there you have it. The underwriter's Bible: capacity, capital, and collateral. They are analyzing your ability to pay, your financial resources, and the security of the asset itself. They're not trying to be difficult. They're trying to build a complete, verifiable story of your financial life to justify a massive investment. Your job before you even apply is to make sure that story is clear, consistent, and compelling. You've now seen the blueprint lenders use to approve or deny a loan. You understand what they're looking for and the red flags that make them nervous. But knowing the rules of the game is one thing. Playing it perfectly is another. Even with perfect credit and a solid DTI, countless buyers get their pre-approval letter, go house hunting, and then make one of a handful of critical, catastrophic mistakes in the weeks leading up to closing, mistakes that can shatter their dreams at the 11th hour. These are the unwritten rules, the cardinal sins of the mortgage waiting game that your loan officer prays you don't commit. And in the next part, we're going to expose every single one of them. Alright, let's pull back the curtain. You've been pre-approved. You're under contract. The finish line is so close you can almost taste the celebratory pizza on the floor of your empty new living room. This is the most dangerous period of the entire home buying journey. It's called the quiet period for a reason. Your lender wants everything to be perfectly still, a frozen snapshot of the finances they just approved. But life happens, and temptation whispers. Here are the cardinal sins, the absolute deal breakers you must avoid. First up, the big one: the one that causes loan officers to wake up in a cold sweat. We'll call it the stability shatter. Changing or quitting your job. You might think, I got a better offer. More money. This will look great to the lender. Wrong. It's a nuclear bomb dropped on your loan application. Lenders don't approve a person. They approve a risk profile. And that profile is built on a foundation of stable, predictable income. The moment you change jobs, that foundation turns to dust. Your entire file has to be reevaluated. If your new job has a probationary period, say 90 days, your loan is dead in the water until that period is over. If you switch from a salaried W-2 position to a commission-based or self-employed role, you might as well have withdrawn your application. Lenders typically need to see a 2-year history of that type of income to even consider it. I saw a deal fall apart 3 days before closing because a client, an IT specialist, took a fantastic new job with a 20% raise. The problem? It was a contract-to-hire position. The underwriter saw the word contract and slammed on the brakes. The stability was gone. The deal was gone. Do not, under any circumstances, change your employment status without talking to your loan officer first. It is the fastest way to go from homeowner back to tenant. Next, let's talk about the siren song of new debt, the most common and devastating mistake. Making a major purchase. This is the classic blunder. You're excited. You're picturing your new life in your new home. You see a Memorial Day sale on a brand new sectional couch, a big screen TV, and a state-of-the-art refrigerator. The store offers no interest for 24 months. Feels like free money. It feels like a smart move to have everything ready for move-in day. But what you don't see is the underwriter's perspective. They don't see a couch. They see a new liability. They don't see a deal. They see a new monthly payment that wasn't factored into your debt-to-income ratio. And worse, they see a brand new credit inquiry. Lenders do what's called a soft pull on your credit right before closing to make sure nothing has changed. When that new inquiry from Bob's Discount Furniture pops up, alarm bells start ringing. Your loan officer gets a frantic call. You have to write letters of explanation. They have to verify the new debt, recalculate your DTI, and resubmit your file. If that new payment, even a small one of $100 a month, pushes your DTI over the edge of the program's limit, even by 0.1%, your loan is denied. The same goes for buying a car. That is the ultimate dream killer. A $500 car payment can single-handedly destroy your ability to qualify. The excitement of a new car will fade very quickly when you're using it to move your stuff out of the house you just lost. Wait until the keys are in your hand. Wait until the deed is recorded. Wait until you have officially closed. Then and only then can you go shopping. Now for a more subtle but equally venomous mistake, the phantom deposit. This is when large, unsourceable sums of cash suddenly appear in your bank account. To you it's innocent. Maybe you sold your old car for $3,000 cash on Craigslist. Maybe your grandma gave you $5,000 as an early housewarming gift. You deposit it, thinking you're boosting your reserves and making your financial picture look even stronger. To an underwriter, this is a 5-alarm fire. They are legally required by federal anti-money laundering laws, like the Patriot Act, to source and document every significant deposit. They need to know where that money came from. Cash is not a source. It's a giant red question mark. Is it an undisclosed loan from a friend that you have to pay back? If so, that's a new debt that wasn't on your application. Is it from an illicit source? The underwriter doesn't know, and they will not take the risk. Any cash deposit that seems out of character for your normal banking history will require a mountain of paperwork. A signed gift letter if it was a gift, a bill of sale, a copy of the check, and a paper trail a mile long. If you can't prove, beyond a shadow of a doubt, where that money came from, the lender will disregard it entirely, and it could even cast suspicion on your entire application. If you need to deposit cash, talk to your loan officer before you walk into the bank. They will tell you exactly how to document it, so it doesn't blow up your loan at the last minute. Here's another one that trips people up because it feels like you're being responsible. Co-signing a loan for someone else. Your brother needs a car for his new job. Your cousin needs help getting her first credit card. You're in a great financial position, you've just been approved for a mortgage, so you think, what's the harm in helping out? The harm is that in the eyes of your mortgage lender, that debt is 100% yours. It doesn't matter if your brother swears on a stack of Bibles, he'll make every payment on time. It doesn't matter if you never intend to pay a single dime on it. When the lender runs that final credit check before closing, that new auto loan will appear on your report. Your debt-to-income ratio will be recalculated with that full payment included. I've seen this happen. A borrower co-signed for his son's $200 a month student loan 2 weeks before closing. It was just enough to disqualify him. He had to beg his son to try and refinance the loan into his own name immediately, a process that was impossible to complete before the closing date. They lost the house. Don't be a hero. Your only financial responsibility during the loan process is to yourself and to getting those keys in your hand. Finally, let's talk about the credit card shuffle. People get nervous about their credit scores during the mortgage process, and sometimes they try to optimize it. They'll pay off and close an old credit card, thinking that getting rid of an account will look good. This can backfire spectacularly. Closing a credit card, especially an older one, can actually lower your credit score. Why? Because it reduces your overall available credit, which instantly increases your credit utilization ratio. It also shortens your average age of accounts. Both of these are major factors in your FICO score. On the flip side, don't open any new credit cards either, for all the reasons we've already discussed. New inquiry, new potential debt. And for the love of all that is holy, do not max out your existing cards. People do this. They start buying moving supplies, paying for deposits on utilities, maybe a new lawnmower, all on credit. If your credit utilization spikes from 10% to 80% a week before closing, your score could plummet 50 to 100 points. That drop could not only change your interest rate for the worse, but it could push you below the minimum credit score required for your loan program, leading to an instant denial. The rule is simple. Treat your finances like they are frozen in amber from the moment you are pre-approved until the moment you close. Don't move money around unnecessarily. Don't make any changes. Don't buy anything. Don't help anyone. Become a financial hermit. This short period of extreme discipline is the price you pay for decades of homeownership. Breaking any of these rules is like fumbling the ball on the 1-yard line. You've done all the hard work, but one careless mistake can cost you the entire game. Now that you know what not to do, you're armed with the most critical information to protect your loan. But there's one final hurdle. The last boss battle. It's the stage where everything is scrutinized under a microscope one last time. It's called final underwriting and getting the clear to close. This is where last-minute conditions can pop up and threaten to delay everything. And in the next part, we're going to walk you through that final nerve-wracking step, so you know exactly what to expect and how to ensure a smooth, on-time closing. This final stretch is where the marathon runner sees the finish line. You've done the heavy lifting, submitted mountains of paperwork, and your loan processor has packaged it all up for the final verdict. This is the moment your file goes back to the underwriter for one last look, a process that culminates in 3 of the most beautiful words in the English language: clear to close. Getting that clear to close, or CTC, is the official green light from the lender. It means the underwriter has reviewed everything, signed off on all the conditions, and the lender is now fully committed to funding your loan. It's the signal that the closing date you've had circled on your calendar is real. But getting from final submission to clear to close involves a few critical last-minute checks, and this is where many buyers get tripped up. It's the final boss level of the mortgage process. First, the underwriter will perform a final verification of employment. Yes, again. They'll call your employer, sometimes the day of or the day before closing, just to confirm you are still employed in the same position with the same pay structure. This isn't because they don't trust you. It's because their entire decision was based on your stable income, and they need to ensure nothing has changed right up to the very last minute. If you've been thinking about switching jobs, even for a promotion or a higher salary, this is the absolute worst time to do it. Wait until after you have the keys in your hand. A job change, no matter how positive, can force the entire underwriting process to start from scratch, and it could kill your deal. Second, they will do what's called a credit soft pull. This is not a full hard inquiry that dings your score. Instead, it's a high-level scan of your credit report designed to answer one question. Have you taken on any new debt? This is the #1 closing killer. I've seen it happen dozens of times. A buyer gets their conditional approval and thinks they're in the clear. They go out and finance a new truck to haul things to the new house, or they open a new credit card at a furniture store to get 0% financing on a new living room set. They're excited, and it's understandable. But that new monthly payment for the truck or the furniture just blew up their debt-to-income ratio. The underwriter sees this new debt on the soft pull, reruns the numbers, and suddenly, the buyer no longer qualifies for the mortgage. The deal is dead, all for a couch or a car they could have waited just a few more weeks to buy. The golden rule is this: From the moment you apply for a mortgage until the moment you close, your financial picture must remain in a state of suspended animation. Do not open new credit lines. Do not make large purchases on existing credit. Do not co-sign for anyone. Don't even change your cell phone plan if it requires a credit check. Freeze everything. Alongside these checks, the underwriter is clearing any remaining prior to closing conditions. Maybe they needed a final, updated bank statement, or a letter of explanation for a specific withdrawal, or proof that an old collection account was paid off. These are typically minor housekeeping items, but they must be satisfied. This is why it's so important to be hyper-responsive to your loan officer and processor during this final week. A delay of a few hours in sending them a document could mean the difference between closing on Friday or having to wait until next Tuesday. Once all conditions are met, employment is verified, and the credit soft pull comes back clean, the underwriter issues the clear to close. A wave of relief washes over everyone. Your loan officer calls you with the good news. The title company is notified, and the process of scheduling your final signing appointment begins. But right on the heels of that CTC comes one of the most important documents you will receive in this entire process: the Closing Disclosure, or CD. The Closing Disclosure is a 5-page, standardized government form that lays out, in black and white, the final exact terms and costs of your loan. It's the successor to the old HUD-1 settlement statement, but it's designed to be much clearer and more consumer-friendly. You will get this document from your lender at least 3 full business days before your scheduled closing. This is not a suggestion. It's a federal law called the TILA-RESPA Integrated Disclosure Rule, or TRID. The government mandates this 3-day review period, so that you have time to look over the final numbers without being rushed at the closing table. You can't waive this period. If your closing is on a Friday, you must receive and acknowledge your CD by Tuesday at the latest. This 3-day rule is a frequent source of delays. If there are any significant changes to the CD after you've received it, for instance, if the loan product changes, the APR increases by more than a small fraction, or a prepayment penalty is added, the 3-day clock resets and your closing will be pushed back. This is why it's so crucial that you review your closing disclosure the moment you receive it. So what are you looking for? First, compare it to the last loan estimate you received. The whole point of these new regulations was to prevent lenders from surprising borrowers with higher fees at the last minute. The numbers on your CD should look very similar to the numbers on your loan estimate. Go through it section by section. Check the simple stuff first. Is your name spelled correctly? Is the property address correct? Then look at the core loan terms on page 1. Is the loan amount what you expected? Is the interest rate the one you locked in? Is the monthly principal and interest payment correct? Check the box to see if there's a prepayment penalty or a balloon payment. For most standard loans, these should both say no. Next, flip to page 2, the breakdown of closing costs. You'll see loan costs, which are fees from the lender, and other costs like title insurance, appraisal fees, and government recording charges. Some of these fees have zero tolerance for change from the loan estimate, like the lender's origination fee. Others have a 10% tolerance, and some can change freely, like prepaid interest or your homeowner's insurance premium. The most important number on this entire document is at the bottom of page 3. Cash to close. This is the exact dollar amount you need to bring to the closing table. This is your down payment, plus your closing costs, minus your earnest money deposit and any seller credits. This is the number. Needs to be right. If anything looks off, if a fee seems too high or you don't understand a charge, you need to call your loan officer immediately. Don't wait. This is your last chance to get it corrected before closing. While you're reviewing your CD and waiting for the 3-day period to pass, a few other things are happening in the background. You'll be scheduling the exact time and place for your closing, which is usually at the office of the title company or an attorney. You'll also perform a final walkthrough of the property, typically 24 hours before closing. This is not another inspection. This is your chance to verify that the property is in the same condition it was in when you agreed to buy it, that all agreed upon repairs have been made, and that the seller hasn't punched a hole in the wall while moving their couch out. You check to make sure the appliances that were supposed to stay are still there, and that the plumbing and electricity are working. If you find a major issue, like a burst pipe or a broken window, you raise it with your agent immediately before you sign the final papers. Finally, you need to arrange your funds for closing. That cash to close number on your CD needs to be delivered to the title company in a secure, verifiable form. A personal check won't cut it. For most transactions, this means either a cashier's check from your bank or a wire transfer. A wire transfer is the most common method. Your title company will provide you with their wiring instructions, which will include their bank name, routing number, and account number. And this brings me to the single most important warning in this entire series. You must be on high alert for wire fraud. Scammers are incredibly sophisticated. They hack into email accounts and send fraudulent wiring instructions that look completely legitimate. They'll use the title company's logo, the correct names, and a similar-looking email address. An unsuspecting buyer then wires their entire life savings, tens or hundreds of thousands of dollars, to a criminal's bank account, and the money is gone forever. To prevent this, you must verbally confirm the wiring instructions. Before you send anything, pick up the phone and call a known, trusted number for your title company or closing attorney. A number from their official website or one your agent gave you at the beginning of the process, not a number from the email itself. Read them the account and routing numbers and have them confirm digit by digit that they are correct. Never ever trust wiring instructions sent solely via email. So the final days are a flurry of activity. Reviewing the CD, doing the walkthrough, and securely transferring your funds. You've navigated the final hurdles, dodged the closing killers, and protected your money. You have the clear to close, the final numbers are confirmed, and your money is safely with the title company. The only thing left to do is show up, sign your name, and get your keys. You're walking into that closing room prepared and confident. But what exactly happens in that room? What are you signing, who is there, and what does it all mean? In our next part, we'll pull back the curtain on the closing appointment itself, demystifying that stack of papers so you can walk in with confidence and walk out as a homeowner. The room itself is often surprisingly plain. A standard conference table, a few chairs, maybe some generic art on the wall. But the feeling in that room, it's anything but plain. It's thick with anticipation, a mix of excitement and nerves. This is it. The final step. The closing table. For weeks, maybe months, this has been an abstract concept, a finish line somewhere in the distance. Now you're here, and in front of you is a stack of paper that looks about an inch thick. It's intimidating. Feels like the final exam you never studied for. But it's not. Every single page in that stack is something you are not only capable of understanding, but something you must understand. So let's pull that stack apart, document by document. Your guide in this process is the closing agent, sometimes called a settlement agent or escrow officer. Think of them as the neutral third-party conductor of this financial orchestra. Their job is to ensure the contract is executed correctly, that the seller gets their money, the lender's loan is secured, and that you, the buyer, get clear title to the property. The very first thing they'll do is ask for your photo ID. This isn't just a formality. They are legally required to verify that the person signing these legally binding documents is, in fact, you. Now for the main event, the paperwork. The undisputed heavyweight champion of this stack is the closing disclosure, or CD. You should have already received a preliminary version of this document at least 3 business days before this meeting. That 3-day rule is federal law, designed to give you time to review it and ask questions without being under pressure. The document you're looking at now should be the final version, and your first job is to play a game of spot the difference. Compare this final CD to the one you received earlier. The numbers should be identical or extremely close. If there are any major unexpected changes, you need to stop and ask why right then and there. The closing disclosure is the final, itemized receipt for the biggest purchase of your life. Breaks down everything. On the first page, you'll see the loan terms in plain sight. Your loan amount, your interest rate, your monthly principal and interest payment. Does this all match what you were promised? Below that, you'll see your projected payments, which will include an estimate for escrow. That's your property taxes and homeowner's insurance. Then you'll see the cash to close amount. This is the exact dollar figure you need to bring to the table, the final number after all your credits, your deposit, and your loan amount have been factored in. The following pages break down every single closing cost, line by line. Who is paying for what? You'll see the loan costs charged by the lender, the title insurance fees, the government recording fees, and any prepaid expenses like property taxes or insurance premiums. It's a lot of numbers, but they tell a simple story, where every single dollar is going. Take a moment, breathe, and review it. Once you've confirmed the numbers on the CD, you'll move on to the next major document, the promissory note. If the closing disclosure is the receipt, the promissory note is the IOU. This is your personal promise to repay the loan. It is one of the most direct and powerful documents you will sign. It states the total amount you're borrowing, the interest rate, the dates your payments are due, and where to send them. It also clearly outlines the consequences of failing to pay, which is the default clause. This document doesn't get recorded in the public record. It's the personal contract between you and the lender. It's your financial handshake, legally binding you to repay the money that is making this entire day possible. Next comes the security instrument. Depending on your state, this will either be called a mortgage or a deed of trust. While they function similarly, there's a key difference. A mortgage is a two-party agreement between you and the lender. A deed of trust adds a third party, a trustee, who holds the title and trust until the loan is paid off. But their purpose is identical. This document secures the loan. It links your promissory note, your promise to pay, directly to your new house. This is the document that gives the lender the right to foreclose on the property if you don't uphold your end of the deal. If the promissory note is the what, the when, and the how much you'll pay, the mortgage or deed of trust is the or else. It's what makes your home the collateral for the loan. It's a sobering document, but a necessary one. Then you'll encounter the deed. This one is different. This is the document of transfer. The seller will sign a deed that officially transfers ownership from them to you. You'll want to look at this document very carefully to ensure your name is spelled correctly and that you are taking title in the way you intended, whether that's as a sole owner, with a spouse as joint tenants, or another arrangement. An error here can cause major headaches down the road. This deed is what gets recorded in the county land records, creating a public, permanent notice that you are the new rightful owner of the property. After those big three, you'll sign a flurry of other supporting documents. There will be an initial escrow disclosure statement, breaking down how your escrow account will work for the first year. You'll sign a W-9, allowing the lender to report the interest you pay to the IRS. There might be affidavits where you swear that you are who you say you are, that you intend to occupy the property as your primary residence, and that you haven't incurred any new, undisclosed debt since you applied for the loan. These are the supporting actors, each playing a small but important role in making sure the transaction is legal, transparent, and above board. As you're signing, you'll be asked to present your cash to close. This is typically done via a cashier's check or a wire transfer. And this brings us to one of the most critical warnings in the entire home buying process: wire fraud. Scammers are incredibly sophisticated. They hack into email accounts and send fraudulent wiring instructions that look completely legitimate, tricking buyers into sending their life savings to a criminal's account. Let me say this as clearly as I can. Never trust wiring instructions sent to you in an email. Before you ever send a wire, you must verbally confirm the instructions by calling the title company using a known, trusted phone number, one you found on their official website or from your real estate agent, not one from the email itself. Verifying this over the phone could be the single most important call you make in this entire process. So you've signed every page, your hand is cramping, and you've handed over the check. Are you done? Not quite. The final step happens after you leave the room. The closing agent now has to fund the transaction. They take your funds and the much larger sum of money from your lender and disperse everything. They pay off the seller's old mortgage, pay the real estate agents, pay themselves, pay any other vendors, and give the remaining profit to the seller. Simultaneously, they will send the deed and the mortgage to the county recorder's office to be officially entered into the public record. Only when the loan has funded and the deed is recorded are you officially the owner. This can sometimes take a few hours. And then it happens. You get the call. Or maybe your agent is there with you. The keys are placed in your hand, and they feel heavier than you expect. They're just small pieces of metal, but they represent the culmination of this entire journey. The saving, the searching, the applications, the underwriting, the waiting, the signing. They represent the front door to your future. You walk out of that unremarkable office, and the world looks a little different. But the journey isn't over when you get the keys. In fact, a whole new one is just beginning. What happens next? When is that first mortgage payment actually due, and how do you make it? What should you be doing in your first year as a homeowner to set yourself up for financial success and avoid common pitfalls? In our final part, we'll go beyond the closing table and into your new life, creating a roadmap for a successful first year of homeownership. You've got the keys. You've taken the triumphant selfie in front of the sold sign. The boxes are slowly getting unpacked, and for the first time you're standing in a space that is truly unequivocally yours. This is the moment you've worked for. But as the adrenaline of closing day fades, a new reality sets in. The mortgage was the gate. Homeownership is the entire kingdom you now have to manage. Your first year isn't just about decorating. It's about laying the financial and operational foundation for decades to come. This is your masterclass in not just buying a house, but successfully owning it. The very first thing you need to do before you even pick out paint colors is to set up your mortgage payment. Do not wait for the first bill to arrive in the mail. Go to the lender's website, create your online portal, and link your bank account. Better yet, set up autopay immediately. Why the urgency? Because your on-time payment history is the single biggest factor in your credit score. A single late payment in your first year can undo months of hard work and damage your financial reputation right out of the gate. Your first payment is a statement. It says, "I am a responsible homeowner." Make it a loud and clear one. Next, while the movers are still in your driveway, call a locksmith. Change every single exterior lock. You have no idea who has a key from the previous owners, a contractor, a dog walker, a distant relative. This isn't about paranoia. It's about peace of mind. It's the first official act of claiming your space and securing your sanctuary. While you're at it, check the batteries in all smoke and carbon monoxide detectors. These are the small 5-minute tasks that have monumental importance. Now for the less glamorous but equally critical logistics. Immediately transfer all utilities into your name. Water, gas, electricity, trash, internet. Create a master list with account numbers and contact information. At the same time, set up mail forwarding with the post office. A missed utility bill can lead to late fees or even a service shutoff, while a missed piece of mail from your lender or the county tax assessor could have serious consequences. To manage all this new paperwork, create a home command center. This can be a physical binder or a dedicated folder on your computer. Scan and save everything. Your closing statement, the inspection report, appliance warranties, receipts for any repairs. This binder is your home's official record. When your dishwasher breaks in 3 years, you'll know exactly where the warranty is. When you go to sell the house in 10 years, you'll have a detailed history of every upgrade. With the immediate tasks handled, your focus for the first 3 months shifts to one primary mission: rebuilding your financial fortress. Your savings account probably looks like a battlefield after the down payment and closing costs. It's time to aggressively replenish your emergency fund. Your old goal of 3 to 6 months of expenses needs to be recalculated. Your new expenses now include the full pity payment, principal, interest, taxes, and insurance. This is your non-negotiable safety net. But you need a second separate savings account. This is your home maintenance fund. And it's what separates the financially savvy homeowners from the ones who are constantly stressed. A good rule of thumb is to save 1 to 3% of your home's value each year specifically for maintenance and repairs. If you bought a $400,000 house, that's $4,000 a year, or about $333 a month that you are automatically transferring into this dedicated account. This isn't for new furniture or a kitchen remodel. This is for the inevitable. It's for the water heater that will fail on a cold winter morning. It's for the AC unit that will die during a summer heat wave. When that happens, you won't panic. You won't reach for a credit card. You'll calmly dip into the fund you've been building for this exact moment, turning a potential financial crisis into a manageable inconvenience. As you move into the middle of your first year, it's time to get intimately acquainted with the physical structure of your home. You are no longer a tenant who can call a landlord. You are the landlord. Create a seasonal maintenance checklist. In the spring, it's cleaning the gutters, checking the roof for damaged shingles, and having your HVAC system serviced before the summer heat. In the fall, it's clearing leaves away from your foundation, draining your sprinkler system, and getting your furnace inspected. These proactive tasks will save you thousands of dollars in emergency repairs down the line. This is also the time to build your personal team of trusted professionals. Don't wait for a pipe to burst at 2 in the morning to start frantically searching for a plumber. Ask your neighbors for recommendations. Use local community forums. Find a reliable plumber, electrician, and HVAC technician before you need them. Put their numbers in your phone. Establishing these relationships when it's not an emergency is a game changer. Around the 6-month mark, you'll likely receive a notice about your property taxes or homeowner's insurance. This is where many new homeowners get confused. If you have an escrow account, your lender pays these bills on your behalf from the money you pay them each month. But these costs can and often do change. Your home might be reassessed at a higher value, increasing your property tax bill. Your insurance premium might go up. When this happens, your lender will conduct an escrow analysis and adjust your monthly mortgage payment to cover the new, higher costs. That letter informing you that your mortgage payment is increasing by $100 a month can be a shock, but it's a normal part of homeownership. By understanding it ahead of time, you can budget for it and avoid the surprise. As you round the corner toward your one-year anniversary, it's time to think long-term. You've likely been dreaming of renovations since day one, but after living in the space for a year, you have a much better understanding of how you actually use it. You now know that the terrible lighting in the kitchen is a bigger problem than the dated bathroom tile. You understand the flow of the house. Now you can create a priority list that's based on function and need, not just initial cosmetic desire. Separate the wants from the needs and plan your future projects strategically, saving up for them instead of financing them. This is also an excellent time to apply for your homestead exemption. This is one of the most underutilized perks for new homeowners. In most states, if the home is your primary residence, you can apply for an exemption that reduces the assessed value of your home for tax purposes, directly lowering your property tax bill. It's free money that you are leaving on the table if you don't apply. Check your local county assessor's website for the deadline and the application process. Finally, take a moment to reflect on the immense psychological shift you've undergone. You've weathered your first year. You've fixed a leaky faucet, you've paid the bills, you've started to build equity. You've transformed a structure of wood and drywall into a home filled with your life. You've learned that the true value of homeownership isn't just in the financial appreciation of an asset. It's in the stability, the pride, and the freedom to create a space that is entirely your own. This entire journey, from the first credit check to your first anniversary as a homeowner, has been about more than just guidelines and paperwork. It's been about empowerment. It's been about giving you the knowledge to navigate one of life's biggest decisions with confidence and clarity. You didn't just sign a loan. You made a strategic investment in your future. You are no longer just dreaming of a home. You are building one day by day, payment by payment, memory by memory. You've done the work. You understand the system. And you are now fully equipped for the incredible journey ahead. You've got this.